Hey guys, welcome. It is 1 o'clock. We just got the closing bell on January 31st. We were expecting a really volatile day and we definitely got it. Hopefully you can hear me okay. My normal microphone is down at the moment, so I'm using a different one. You're probably hearing a lot more background noise, and I apologize for that. But as far as the market goes, we definitely got some really interesting and we definitely got the volatility that we thought we were going to get. So let's take a look how the day developed and all the things that are relevant to us. One thing that I noticed was that over the last couple of days, we've been talking about volatility a lot, and I don't know why it just never occurred to me until now to actually do a trade in volatility. So we'll look at that. We'll see if it's not too late to do a volatility trade. It would have been great through the FOMC meeting, but or announcement, but it might not be too late. So you can see we had muted trading most of the day, the size of these candles relative to the size of these candles. So definitely a lot more movement in the afternoon after we got that FOMC meeting or announcement. You see that we initially went down, we tried to recover, we went back up, and then it was just all down from there. And was it moved so far down that we didn't even have a line for for these levels down here. If we looked hard enough, we would have found some, but we weren't anticipating this level of movement. So for sure, downward movement. And because of the nature and the reasoning for the downward movement, I'm not necessarily going to look for a reversal this time. I'm not looking for the market to go swing back up over the next couple of days. We might at the open to try to fill some of this, but I don't expect us to reverse direction and just start making new highs in the markets again. And I'll tell you why. It's because of the main reason where we got this downward movement is because of what Powell was saying. And he indicated that the chances of a March rate hike are very low. And we can see that now no one is expecting a 50 basis point cut anymore. It was 0.8%. A month ago, it was 15%. And now it's 0%. And then after his speech, we were down at 35% for a 25 basis point rate cut. So I don't know if you remember, but over the last couple of weeks, I've been mentioning that my expectation is that this would drop below 30%. I think we might have a little bit more to go. So tomorrow we may wake up and see that this is even lower. If that happens, if that continues, then we will see TLT move down and put pressure on the NASDAQ stocks. So we should see continued movement downward on the NASDAQ, and that should drag down the S&P 500. The big question is, will it drag down all sectors, or will it only be in the tech and speculative sectors? So we'll see if we can get a little bit of a clue on that right now. First, QQQ pulled right back into that EMA 20 level that we were talking about. So we'll want to see if this holds. If we break through, then it's going to be this previous all-time high that we highlighted over here. SPY down through the EMA 8, not quite at the EMA 20 yet. So we'll want to see that pull back into that EMA 20 and see if that holds. If I look at the Dow Jones did eventually get dragged down with everything else, but the EMA 8 held. So if this EMA 8 continues to hold, then we'll see a separation in the sectors. The tech and speculatives continue to go down, and then the defensive ones maybe still potentially go up, or we get that pullback correction and all sectors start at a level playing field again, and then we'll see which ones start leading. And if it's the growth stocks again, small cap stocks again, then that will be a signal for at least a couple months of upward movement. Otherwise, we'll have to see when we get there. So let's take a look at the VIX. VIX moved upward beyond this blue line right here. It didn't really spike too high. High of today was 14.61. So that's not too bad. I would think that it could easily reach at least somewhere near this 20 region. 18, 19, 20 is where we would, I don't know why these, I get 18, 19, 20 is, so in this region where we get a lot of movement right here, that's what we would expect if we start seeing a pullback. So VIX, maybe not as a outright play, but as a hedge could make sense. Let's take a look at our sectors. And we're just mostly interested in today. So TMF, or basically TLT, did the best, still up. That's interesting. So we did break through the MA200 and traded upwards. And even after the announcement, we're still up there. That is kind of interesting. But we would have thought that with the no rate cut in oh no, what am I saying? No rate cut. So higher, yeah. But interest rates are higher for longer. So we would have expected this to pull back down below the MA200, which it didn't. So it'll be really interesting to watch through the end of this week how TLT performs. If it keeps going up here, then maybe we won't get that pullback or correction that we were thinking we would in the NASDAQ. We'll probably need to see how Apple, Amazon, and Meta turn out for their earnings before we make that determination. But right now, this is surprisingly strong in the bonds. There could also be a flight to quality, but the interest rates, they directly affect these bonds. So yeah, so I definitely want to watch over the next couple of days, see what the reaction is after that, after a couple of days. So we'll keep an eye on that one. And then let's take a look at our sectors. Aerospace and defense. That is interesting. The only sector up today is aerospace and defense. It's not even that far up though. It's only went up 0.52%. That is a really kind of indecision bar right here, and it really just looks like it just went sideways. It is now above all of its moving averages though, so we'll definitely keep our eye on this and hope it doesn't reflect impending conflict. Okay. The healthcare, defensive sector, utilities, defensive sector, staples, defensive sector. So all of our defensive sectors on the top. They did lose money today, but not that much. And definitely less than everything else. And tech is down 1.67, communications down 2.22. So the defensive sectors are definitely doing better than the speculative ones, but everything is just down today. So let's see where, if anything, is breaking a trend. Okay, so we want to watch TLT. We want to watch bonds very carefully because they did break above their MA200. This is the, I shouldn't use TMF. I should use TLT. Okay, yeah, aerospace is looking kind of positive, but we'll have to see. Same with TLT. Looks like it's moving upwards. Healthcare, mostly chopping sideways, but still looking very healthy. Gold, chopping sideways. Utilities, we would want to see it move above that MA200. Staples is looking like it's waking up. So staples would be something to watch very carefully. Real estate on a downward trend. Financials are looking very good. Industrials, maybe. I'd want to wait and see a few days. Materials, not quite yet. S&P 500 looks like it might be topping and breaking down, but we'll have to see if that EMA 20 holds. Semiconductors, the exact same picture. Silver sideways, energies. We want to see it get beyond this jungle of moving averages here. Home builders, sideways. Consumer discretionary, slightly weak, even though it's mostly sideways, it is slightly weak. QQQ, obviously, it pulled back to that EMA 20. We want to see if that holds and we can bounce or if that's going to break. Retail, mostly sideways, looking a lot like consumer discretionary, which makes sense because it's a subsector of that. And then technology, looking the same as SPY, SPY, same with XLC. And the small cap stocks looking, they're solid, consolidating and looking for a direction, so that we can't really say about the small cap stocks yet. So the only one that looked like really solid was XLP on the way up. So that's very defensive, and we want to watch the earnings reports of Meta, Amazon, Apple the next couple of days. We want to keep our QQQ shorts on. We can, in just a moment, we'll take a look at a VIX hedge. And then, yeah, I'd be very careful. Very careful tomorrow. We could get that swing back off of the FOMC. We could get a swing back. But again, I don't expect it to overwhelm this movement this time. We could pull back up to maybe this second or fourth purple line right here. I don't expect us to really start trending in that direction though. Okay, so let's take a quick look at VIX. VIX. So if I were to do a VIX call, I would give myself some time. I wouldn't want it to start losing time value too quickly, even though we do feel like it would be imminent in the next 1 to 2 weeks. It's better to give ourselves a little bit of time. So March would be the earliest, the absolute earliest I would do for expiration. Maybe April would be a little bit better. Let's see what April looks like. My options table over here. Come on. There we go. And if we look in April, if I want it to go up, you know what? I would go deeper in the money. And so if I go deep in the money, then I can do March. And I do this 10, 10 and a half, or 11. I'll put in $500. Let's just say I did the 11. Let's see how that would work out. If I do the 11, I am risking $500, but I'm not going to hold it all the way till March. So realistically, we shouldn't see a complete deterioration. We shouldn't lose all my money in this. Right? So let's just go out. So this is the March expiration. Let's just say we want protection through February. So if I want out until I'll just say Feb 23rd. And just say it goes nowhere. We go back to 12, or we go back to where, let's see where the recent baseline was. Okay, so if we come back to, 12, this area right here, 12, we pull back down. So that means we were wrong. VIX did not spike up, but we're using this as a hedge. So really we're not wrong because we are still trending upwards. We don't want to put on full-size positions against the trend. We want to put on baby positions with really high reward risk ratios against the trend as hedges. So if it goes back to 12, then we go down to 0.35. So we go back down to 12, then my option is priced at 235. If I paid $470 for it, then I lose $235. So I lose exactly 50%. What if we go up to 18, 19, or 20, like we were expecting that it could happen if we get that pullback? So if I go up another $4, that takes me to 1835. We'll just start with there, a little conservative, right? See where we goes and see if we could double. The answer is maybe, almost. So 470 out to $8 is $3.30. So I would have $3.30 versus $2.35. So that is about a 1.5 to 1, maybe. $2, what do we say, $3.30? Yeah. Okay, so 1.4 to 1, almost a 1.5 to 1 reward risk ratio. So that's good. And we're conservative because we don't want to lose $500. I could go way out here. My probability goes lower. I risk a lot less. And if we move all the way up, well, we wouldn't go that far out. We would go out, just say maybe 16 or 17. We could play around with that. It just depends. But here, I know that I'm putting at about $235 at risk, call it $250 at risk. I could do the same thing out here and just say I'm willing to lose 100% of it, and then that way I have less capital to put up at the beginning as well. So we'll finish this one and then we'll compare it to one of these out here. So if we then go to, just say we go up to 20. So if I do 5.65, then we could theoretically reach 1060 or 960. So 9.6 minus 4.7 divided by 2.35. Then I would have over a 2 to 1 reward risk ratio. So this is a good trade, nice and conservative. I don't lose too much in terms of time value because I am in the money. The further out of the money we go, the faster we lose time value as a percentage of what was invested. You can see here all across the board, we're pretty much at losing 2 cents per day. But 2 cents of $5.60 versus 2 cents of 40 cents. That's a huge difference percentage wise that you're losing on a daily basis. So the time value hurts us far less if we go deep in the money. And then the downward movement in prices also hurts us less. The delta relative to my starting value. So 80 cents divided by 470. And it's 17% versus if I chose one of these, or 20 cents versus 60 cents, that's 33%. So 17% versus 33%. So going deep in the money means I lose less percentage-wise because of price movement and because of time decay. So it's a more conservative investment if I do this. But if we want it to be, we're just going for a bigger reward risk ratio, a lower percentage rate win, and I only want to protect myself against big moves, like this deeper in the money would protect me against smaller moves as well as big moves. But this if I go far out the money, then I'm really only protecting myself mostly against big moves. So let's just say we chose this 17. It's a little bit easier, I think, in terms of a mark, $1.35. So what would happen if by February 3rd, we go to that same $20 strike? Well, our theoretical would be 4.18. So 4.18, we'll call that 4.2 divided by 1.35. So we'd go up 200%. So definitely percentage-wise, we make more money than we did over here, because over here we went from $6.70 to $9. So we doubled our money, but here we triple our money. And on the risk side, however, let's see how that stacks up. We go down to $12, so we go down $2.35. Then the theoretical price would be down at 20 cents. So we lose 20 divided by, oops. So we lose 85% of that value. We would lose $1.15 versus gaining, what did we say it was? Okay, 285. So divided by 1.15. Okay, so that's a 2.5 to 1 reward risk ratio. So actually, this one looks like, in terms if we want to hedge, this one, like a pure hedge in our portfolio, this one would act a little bit better on a large move. Actually, it would act significantly better on a large move. But this one's more conservative if you want to be protected against smaller moves as well. So it's really up, do I want to put up $500 of capital, or do I only want to put up 165, being willing to take a large percentage hit, but if it works out as we planned, or the event that we're trying to protect against is, which is a VIX movement up to 20, then this one would do a better job protecting us. So you would buy 3 of these versus 1 of these, and then this one would protect us on that large movement event much better than this one would. Okay. So that's how we look at and evaluate hedges. And then then you would say, hey, okay, this protects me against, if I bought 3 of them, it would protect me against a $500 move in my portfolio. And then you would say, is that appropriate? That if we spike up to a 20 VIX, would my other positions drop $500? Would they drop $200? Would they drop $1,000? And how much of that drop do I want to protect using my VIX hedge? Okay. All right, so hopefully that was clear and thorough. We can consider a VIX hedge, although if you already have a QQQ hedge that's appropriately sized to your portfolio, that's perfectly fine. At this point in time, it's becoming a little bit more clear that we are probably going to get that pullback, or a deeper pullback, I should say, because technically a movement back to the EMA 20 is a pullback, but it feels like there's more to go. The trend is still up. We still want our portfolio leaning positive, but we just have even more reason to take some money off the table, take some profits on positions that would get really hurt if the QQQ moved down through the EMA 20, or to hedge a tiny bit more. So if your portfolio has already took a hit today because of this movement downwards, that's a clue that we're probably leaning a little too much on the positive side. So we would take off a little bit of risk. Okay, that is it for today. Tomorrow, we really want to look out for I guess it's not tomorrow. Let's take a look at our economic calendar. Tomorrow, press conference. No, that's today. Tomorrow's jobless claims. That'll be interesting, but we already got the FOMC decision, so it's probably not going to be super significant. So tomorrow is going to be about digesting and reacting to what happened in the FOMC, and then let's see if we have any significant earnings. C.H. Robinson in terms of transports, MetLife in terms of financial insurance, Qualcomm in terms of tech. All of those, Qualcomm used to be a much bigger deal. Now it's a little bit less. And the other two are not like super big deals. And we've got some staples. Cardinal Health will be important for the healthcare sector specifically. Merck also for the healthcare sector. RCL. RCL would be interesting to watch for the discretionary. But that's about it. Nothing super big. Nothing super big tomorrow in terms of earnings. So we're really just going to see how the market digests what happened. And more importantly, is this an opportunity for market makers? Because they've probably been accumulating a lot of stocks in this movement upwards. And if they finally ran out of room for buying, like the way the physical world analogy would be, my warehouses are full. I only have, you know, hundreds thousand square feet warehouse and I've packed in 999,000 of it. I really can't fit anything else. I've got to start liquidating. And this type of movement and a news event like the FOMC meeting is a perfect excuse to start letting go of my inventory and start making space so that when we come back down, then my warehouse is empty and I can start filling it back up at lower prices. So I have a feeling that after this and this and this, or that's a 20% move we determined the other day, 25. So we'll call it, I don't know how precisely I clicked, but so we'll call it between 20 and 25% move. Probably their inventories are full. So we want to see they're going to want to drive a clearance process, basically get cash back. Right now they're full of stocks, and so now they want to get cash back. And then when they get down here, something like this, when we've had a correction like this, that was a 10% correction right there, then they're they have a bunch of cash, they have less stocks, and now they can start loading up on stocks again. So I have a very strong suspicion that we'll go through that EMA 20 this time. All right, so we'll see. We'll see what happens. We'll see if I'm right. But tomorrow we will expect continued volatility because of the FOMC and just wait and see how everything plays out. Okay, guys, have a wonderful rest of your day, and I will see you tomorrow.